Okay, let's get today's show up and running with Joshua Debisi, who is the head of banking research and analysis at Vetiva Capital Management. Good morning, Joshua. Great to have you.
Good morning, boss.
Thank you. Thank you very much. We appreciate it. This is what you're looking at right now. Is just the numbers that we have on a daily basis, tracking some of the biggest exchanges on the continent, from the GSE, the NSE, which is the Nairobi Bourse, and the Egyptian market finishing in the red. In West Africa, Nigeria, and BRVM, two of the largest securities markets within the West African corridor, finished in the negative territory. Let's go to the East African markets because we're getting the earnings season. I'm sure Joshua is understandably will be interested in Standard Chartered of Kenya reporting half-year profit about 50.9% to about 4.8 billion shillings. We're still on the outlook. Some folks says we'll get in the earnings from GT Holdings Nigeria pretty soon, perhaps much earlier than that of Access Bank. Then you have Kenya's central bank talking about the 21-year infrastructure bond, which bids came in very strongly at 75 billion local currency. Cooperative Bank is continuing its joint venture deal with South Sudan for the next 3 years. At least that's good under the new administration in Khartoum. And Tanzania's smoking earnings, Tanzania's cigarette companies reporting 10% uptick in half-year profit after tax January to June. Joshua, you want to speak about the bank earnings? What's your outlook?
Well, so what we've seen in the East African markets, basically we've seen a lot of positives across the East African markets. Like you said, KCB, Coop Bank, all of them have reported, quite strong recoveries. I know I do, quite loosely follow a few analysts who cover those markets, and the results that they've seen have sort of, to a certain extent, even beaten some of their expectations. So the recovery has been quite positive, quite buoyant. And so, this is, especially Standard Chartered Kenya, you're seeing up 50.9% year on year. That's, that's amazing. So generally, I think theirs has been very much a V-shaped recovery from the lows that we saw, late last year, and maybe a little bit of a stumble earlier this year, but definitely I think it's quite positive. So that's boding well going forward. On the Nigerian front, I mean, we'll get to that, but definitely we're still expecting the banks to continue to post, quite positive numbers. The two banks that I cover that have released results have done, fairly well this year through the half year. So I think definitely you're going to see more of the same from our big players, from your GT, your Zenith, and especially from your Access Bank. I think Access Bank is going to be probably, their results are going to, impress the most, I believe anyways.
Yes, I agree with you. If you look at, if that takes us to the Nigerian West African markets, really, and just to continue on that trajectory, Joshua, because Access Bank has done a few acquisitions recently in East Africa, in Southern Africa, just about, I think about 3-4 months ago. They also went to Congo DRC as well. I'm sure you remember. So do you think these numbers would start coming through with good numbers for Access?
Well, the acquisitions themselves are unlikely to really prop up or, add to the already impressive earnings and, profits that we're expecting to see. So that's just purely down to all the previous acquisitions and the previous mergers that Access has embarked on. We know that they've been very, very aggressive in their expansions. Now, those expansions themselves, even the management themselves will tell you that those expansions are not expected to fully start to yield results until a little bit later on, probably by the end of this year. But their core business, their Nigerian business, their West African business has done so well this year that I think that alone is why we're seeing such, significant strides forward. I think in terms of profitability, Access Bank are soon going to be, in the upper echelon with, their GT and Zenith peers. That will be only a matter of time. Now, for the investors, what their own main concern would then be is in terms of, obviously return on investment, dividend payouts, and the like. Because if
you're expecting
Access Bank were to change their strategy on that front,
you expect any interim payment dividend from Access, Joshua? Do you?
it is more than likely. The fact that they have not released their results yet points to an interim dividend, because if they were not going to release interim dividend, they would have released the results at the same time as FBNH had already, and FCMB had already released. And so definitely, I think it is a very high possibility that there will be an interim dividend. Now that will give us an indicator of where their final year dividend will likely rest. If they increase their interim payouts, then I think investors will be anticipating, a strong jump. And this will have a very, very positive effect on their share price, because I know that investors in the Nigerian space pay a lot of attention to dividend payouts for the banks. So this could, bump them up into that next strata next to their peers.
So here is GT Holding, GTCO, just doing this restructuring and what have you. What's your outlook in terms of interim dividend? You think they will try to sweeten things a little bit for investors?
Well, so the first thing to note is that the restructuring, in terms of capital outlay, is not that capital intensive. Obviously, the other parts of the business that are sort of being spun out and individualized, it's more on paper than a real concerted capital intensive effort. Obviously, they're not embarking on the same kinds of expansions that Access Bank have gone through. Yes. So they will have a lot more access to funds and funding, and so they will be able to return a lot more value to investors through the issuing of dividends. So I think, I'm not entirely sure if they would want to sweeten it, but I'm definitely sure that they would want to keep investors on board and on side. So we can expect that it to be at a minimum the same level it was last year. And, on the optimistic side, definitely we can anticipate a slight improvement.
Okay, well, fair enough. Here is, if I'm trying to drag in a few headlines from Nigeria, with Dangote Cement launching a new 150 billion commercial papers program. Overall, the Dangote Cement has done about 450 billion, nearly a trillion naira now, half a trillion naira in the commercial paper since 2018. Do you think there's still more space at the commercial papers window, looking at the marketplace, Joshua, in terms of what the money market and the debt market is saying?
Well, I think what we're seeing right now is obviously them capitalizing on the yield environment. There have been improvements from the lows that we saw last year, but it's still quite favorable for companies to come into the market and raise debt at a very cheap rate. And I think if you're going to raise debt, now is the best time to do it. Well, the best time to do it would have been 12 months ago, but barring that, you can continue to do so now, in anticipation that the cost of borrowing will go up as time progresses. Now, obviously, this is just watching and waiting to see what happens on the international space with regards to the Eurobond issuance from the federal government, because that will definitely have an impact on local borrowing and the cost of debt.
You think Naira is cheap now, Joshua?
I think definitely.
You think Naira is cheap? You think Naira is cheap? Looking at exchange.
I mean, the market prices it cheap. The market prices Naira very cheap currently. So I think definitely if you are going to go locally, this is now the time to do it.
Okay, so it's the best time to quickly take. If you want to take it in the Naira commercial paper and quickly put it in your local operations working capital, I think Naira is well beaten these days. So you better take it very quickly.
Absolutely.
And drop your dollar content and quickly take on the Naira, because it's a whole lot cheaper for you if you're barring everything. And again, so here we are. That's well understood. Just to wrap up the West African space, with the Bank of America looking to conduct valuations of Ghana's National Petroleum Corporation, which is Nigeria's version of the NNPC, on the oil block purchase they're looking at. Then you have the OPEC Secretary General, Nigerian-born Mohamed Bakindo, starting his 4-day visit to Congo, meeting with his counterparts and the delegation of the authorities in Congo-Brazzaville. That meeting started yesterday. Congo is the latest member of the OPEC cartel. Let's move on very quickly, touching with the Southern African market, because it looks like the market started uptick after beating last week due to NASPA's shares on the GSE. So we've got a very good news how the market started in GSE yesterday. That was good news. We'll talk about that. The currency also went up more than 1% against the US dollar. Of course, dollar, broadly speaking, is down. Globally speaking, if you look at the dollar index against its major peers, as everyone is on the outlook for what the central bank in the US will do as far as stimulus and asset buying program, if the sell down or tapering will start before the end of the year, as indicated. The South Africa's regulator, however, has slammed the withdrawal or suspension of license of a ZAR exchange. ZAR exchange is a fintech-based exchange in South Africa trying to compete and provide some innovation around what the GSE is doing, but there are issues around capital adequacy ratio and liquidity. So they got a bit of a slap on the wrist there. Shoprite is exiting Madagascar and Uganda to focus on South African home market. Charity begins at home. So here we are, Joshua, very quickly. The Shoprite, what do you think is changing as far as these retailers are concerned? It looks like everybody's withdrawing back home to his home base after that massive Pan-African expansion. It looks like everybody's going back home.
Right. What I think we can say is we can draw parallels to, a lot of American companies, where in the early stages, when you are seeing a little bit of success, you think that the next stage for growth is to expand into as many markets as possible, open as many stores, in order to improve profitability. But probably what they were seeing on their books was that their revenue or their income or their profit per store, went down significantly. Because obviously when you spread yourself so thin, there's an issue of quality, there's an issue of management, there's an issue of exchange rates. There's, across the African continent, I can say that Nigeria obviously is the, is at forefront of our minds, but there are other countries that are also going through a lot of challenges as well. So it would have been a difficulty in terms of getting the right quality of stock and then repatriating of funds or of any kind of profits that you get in those markets back to the South African market. And I think what they've realized is that they're not able to manage or extract as much value from all those, far-flung franchises or rather stores as they would be if they just focused on their core business, focused on, maximizing their revenue and their profit from their core markets. So I think definitely they expanded too quickly and spread themselves thin. So I think this is just a regression to the mean. That's really what it seems like to me.
Yeah, you raised a couple of issues of points there, because again, some of the logistics and issues in terms of the goods they distribute and sell at those stores are also very important. If you need to move these goods across borders in Africa, for example, if you want to move them by trucks, for example, from South Africa to markets in Kenya or whatever, you have the whole customs issues, for example, if you do the shipping, if you want to fly some of these goods across, you understand, then you have local content that the authorities would want you to also provide locally in those foreign markets. If you're not able to meet with them or they're not available, then you're not making money because the goods won't be available. And in terms of quality you want, I think there's a whole lot of issues we need to deal with in terms of these stores as you got it. But like you rightly put, in Europe and the US, we've seen some markets doing very well in their home country, like in the UK, Sainsbury, the Lidl, and the rest of them. Yeah, just stay in their own country, and people believe in those brands and they patronize them. So basically, Walmart and the rest. But of course, you've seen some of these expansions even for Walmart. They've tried to come back from some other markets they try to expand to, because again, there's a whole lot of issues you're dealing with. But again, when you have to deal with in-store, in which people have to walk in and walk out, unlike Amazon, that is largely just an e-commerce online, whatever you order, you get it, and whatever is delivered. I think it's a whole thing. Let's move on to North Africa to wrap it up with you, Joshua, this morning. Considering the North African country, Libya, says it's needing oil production well above the current level of about 40% to bring in all the money. Very interesting story about the European Bank for Reconstruction and Development, which is the EBRD, bringing about €250 million to upgrade Cairo's Metro Line 2. This is the kind of money we need in Nigeria, isn't it, to build our metro?
Absolutely.
Are you salivating?
I think
50 million euros, unfortunately, my friend, is a whole lot of money.
Absolutely. But I think what you would say is that Egypt, the Egyptian market is a safer bet, unfortunately. And I think, the fact is they will, even if they want to upgrade, it's just an upgrade. It's not, starting from the ground up.
from scratch.
Because let's be honest, upgrading is a lot easier, at least, from our experience. To upgrade something would be a lot easier than to,
Yeah.
to build from scratch. Because as we have seen, the metros in Abuja and Lagos have stalled quite massively, unfortunately. And no matter how much
Yeah.
capital is poured into it, there never seems to be enough. And we're always behind schedule. There's always a dispute with contractors. There's always a problem. So I think it's definitely a safer bet to take your money to Cairo, to Egypt, because I think you will recoup it through, maintenance, through use over the next 10 years than you would in Nigeria, unfortunately.
I agree with you because again we spoke about this infrastructure investment thing last week at the conference in Abuja, and of course the one of the top officials of the European Union in Nigeria came into the audience and listened, and I actually raised the issue why the European investment banks and the big banks are dealing more with Morocco and Egypt than they're dealing with us in Nigeria. That, like you just raised some points, there's always a problem somewhere. We just keep pouring money in. We don't seem to get results out of it. So who keeps doing that? But 250 million euros free money from EBRD, I'm telling you, this is going to take Cairo and Egypt to another level. If you consider what this would mean in terms of job creation, in terms of revenue, in terms of taxes to the government and modernization, by the way, and the quality of life and living, if you consider that, if you bring it all down, Joshua, we can use a metro, a good metro in Lagos, for example. It will help us the stress some of those of us who are in Lagos and all that on a daily basis. Joshua, thank you so much.
Yeah, no, absolutely.
It's nice having you on the show
Absolutely.
this morning. Thank you,
Yeah.
thank you. We appreciate it. From Vertiva Capital, Head of Banking Analysis
Thank
and
you for having
Research.
me.
Thank you. I'll see you next time on the show. Joshua Odebisi from Vertiva. Have a great day, and see you everyone tomorrow with another edition of the show. I am Bosin Namafaye signing off at this point.